Okay, in this chapter, we're going to talk about the cost of capital. In this case, it should be a fairly straightforward discussion, especially if you already understand the concepts of valuing bonds and valuing stocks. And just to kind of give us a little heads up, let's think about this in terms of renting or borrowing money to buy a car. If you borrow money to buy a car, let's say the bank says you have to pay them 5%. What do you call the 5%? As the borrower, you call the 5% an expense. What does the bank call that 5%? The bank calls it a return. So when we talked about bond and stock returns, that's the money that's given to the investors for providing capital. So what does it cost the company to do that? It's the exact same number. Now we have to adjust it sometimes for taxes, etc. But the idea here is that costs and returns, when you're thinking of financing, are the exact same numbers. So the cost of capital represents the value or the cost of financing. It's the return that ultimately goes to investors. And if you're thinking about projects, this is the minimum rate of return that you would want to receive. So as I was saying there, financial managers, obviously, our goal is to maximize value. So this is one of the benchmarks we use. This is a benchmark, when we're talking about capital budgeting, the required return for the internal rate of return rule is this cost of capital. In the net present value calculation, this cost of capital is the required return or the discount used to find the value of the future cash flows. So the question we have here, or the purpose of this chapter, is we need to identify what this number is for the company. Okay? Now obviously most companies want to have some optimal mix of debt and equity, right? And that's what we'll talk about in other videos about leverage and capital structure. But this doesn't address that question. This just says, look, at this point in time, what does it cost for us to finance operations and investment? So what we're looking for here, since it's the cost of capital, we're really only looking at sources of long-term capital. So essentially we're looking at the cost of debt, the cost of preferred stock, the cost of common stock, and the cost of retained earnings. So let's think about this before we get in too much detail on a more conceptual basis, right? Business risk of the company is the risk of the firm being able or unable to cover their operating costs. And for the cost of capital question, we're going to assume that that's unchanged. So whatever projects we expect to do will not change the riskiness of the company's underlying business. Financial risk, that's the risk of the firm being unable to cover its financial obligations. And again, in this instance, we're going to assume that that is unchanged. What that means is whatever proportion of debt and equity we have chosen, we're going to assume that that stays unchanged. So the business isn't going to change, and the proportion at which we gather money does not change. And of course, we are going to assume that we're going to take into account taxes. So why do we need to determine this cost of capital again? Again, the company has to find investments that are going to maximize firm value. So that means they have to find projects that are going to provide a rate of return that is in excess of the cost of financing. So let's start with our first source, the cost of long-term debt. Now, pre-tax cost, obviously that's just what we obviously pay, right? But typically these funds are going to be raised through the sale of corporate bonds, right? So there's going to be a security that's issued. And issuing securities is not free. So in the end, if you think about what the company gets to keep, right? So if let's say we borrowed $1,000 and the bank says, okay, but we're going to charge you $10 to borrow this $1,000. You say, okay, I can do that. So the bank essentially is only going to give you $990. I'm sorry. They're only going to give you $990. So any investment you make is going to be based on that dollar amount. And what we refer to that as net proceeds. And how you find net proceeds is by applying something called flotation costs. Right? So flotation costs are the total costs of issuing and selling a security. So there are underwriting costs. We obviously have to compensate our investment bankers for selling this security. There are also some administrative costs, legal, accounting, printing. So with respect to debt, flotation costs are fairly straightforward. Now that may change when we get to common stock, but we'll get there in a couple of minutes. So let's think right now. We know that it's going to cost me something to get the money in order to complete the lending or the borrowing transaction. So the cost, the after-tax cost of debt is the before-tax cost times 1 minus t, where t is obviously the corporate tax rate. R sub d is the yield to maturity on our debt. Now, if we assume we only have one loan, or we're only going to have one bond that we issue, this is the cost that we would have to pay to the investors of this bond. So that's, again, the R sub d. This is the before tax cost of debt times 1 minus t. So this corporation is selling a $10 million worth of a 20-year 9% coupon bond with $1,000 par. Because current market rates are greater than 9%, the company is going to have to sell these bonds at $980. So that's the price that they'll receive when they sell each one of these bonds. However, the flotation costs are 2% per bond, or $20. So in reality, the net proceeds, the net amount that the company is going to receive, is really only $960. So we have a worksheet that's called the cost of capital, or the weighted average cost of capital worksheet, and we can start by filling in the bond information. Here's the coupon, 9%, 20 years. The price is $980, but we have flotation costs of 20. So the tax rate is 40%, and the par value of the bonds is $1,000. So what we can get from this is we can get the cost of debt before taxes is 9.45%. So that is the cost that incorporates the flotation costs of issuing this debt. When we incorporate taxes, the after-tax cost is 5.67%. Now, the nice thing about bonds, and we'll talk about this in other videos, is that since you get to write off some of the interest, then the government sort of subsidizes the borrowing of debt. So the actual cost to the company is less than what the before tax cost is, or what they actually are paying. The net amount is less. So now we know this is the process. We're going to find the data that we have. Again, we've already talked about this in previous chapters. We're going to incorporate the cost of debt. The only difference between this 9.45% and the internal rate of return is that instead of using price, we're using net proceeds. So now let's go on and talk about the cost of preferred stock. The formula for cost of preferred, the cost is the dividend divided by net proceeds. So again, preferred stock gives you the right to dividends, right, before they distribute any earnings to common shareholders. So we know about preferred stock. Sometimes preferred is stated as a percentage. Sometimes as a dollar value. But in the end, we have this basic formula that's the dividend divided by net proceeds of the preferred. So our spreadsheet now, again, when we plug in the numbers for preferred, we know that it's $8.70. It's a 10% dividend on $87. So it's $8.70 is the dividend. The cost of issuing expected to be $5 per share. So we know the flotation cost is $5. So the cost of this preferred stock ultimately here is, over here, it's 10.61%. And I don't show you the after-tax cost because since dividends are not tax deductible, the before-tax cost and the after-tax cost are exactly identical. Now, these flotation costs for a dividend can be stated different ways. It could be stated as a percentage of the price. It could be set as a percentage of the par value. It could be set as just a flat dollar amount. But so there's lots of ways that we can ultimately calculate this flotation cost. So those are the first two sources of financing. In the next video, we'll talk about finding the cost of issuing common stock. And then we'll conclude with discussion of the general concept of weighted average cost of capital.